The mortgage process is nothing like it was 20 years ago. Not only are you required to provide more documentation, there are also more guidelines and restrictions that didn't exist 20 years ago. So in this video, I'm going to be sharing 5 of the biggest mistakes that first-time homebuyers make when purchasing their first home. And if you're new to the channel, my name is Enrique. I'm a mortgage broker licensed in California, and I make videos on first-time homebuyer education. So if you like this type of content, make sure you subscribe for more. All right, so without further ado, let's get started. All right, number 1 mistake is not knowing or understanding the 4 parts of a mortgage application. This is critical because oftentimes I get people coming into my office and they're like, hey, does this matter? Does that matter? Does that matter? And oftentimes only a few of those things actually matter on the mortgage application, or they'll be completely stressing about XYZ when XYZ has nothing to do with your mortgage application and how much you qualify for. So the 4 parts of the mortgage application are: number 1, your income. That's going to be the most important because your income is going to determine the size loan that you qualify for. The more income, the more loan; the less income, the less loan. The second part, and almost equally as important as the first part, are your debts. And here we're focusing on the monthly payments for those debts. For example, if you have a car loan with a $500 payment, what we're going to do is we're going to take that $500 payment and subtract it from your income. And like we spoke about earlier, when there's less income, there's less loan. So it doesn't necessarily matter how much you have in debt. For example, it could be a $100,000 car loan, a $50,000 car loan. The bank's not really going to pay too much attention to that. What they're going to focus on is, hey, what's the monthly payment for that loan, for these debts, for these credit cards, for these student loans? And then we subtract that from your income. All right, number 3 is your credit score. So your credit score is going to play a big part in determining your interest rate and also the loan programs that you qualify for. It doesn't really, or at least not directly, influence the size loan that you qualify for. One time I had a client say, hey, Enrique, I have an 800 credit score. What size loan do I qualify for? Well, like I mentioned earlier, the income for the most part is going to determine the size loan that you qualify for. Here, the minimum credit score that you'll need if you're a first-time home buyer would be 580 for an FHA loan or 620 for a conventional loan. All right, and the 4th part to a mortgage application will be your funds, the money that you'll be using to purchase your home. And this is made up of 2 parts. The first part is the actual down payment, which we'll go over later, what the minimum down payment is if you're a first-time home buyer. But that's the first part. It can be 5%, 20%, 30%, whatever the amount is. And the second part that is often forgotten are your closing costs. Closing costs can be anywhere from 2 to maybe even 4% of the purchase price. So when you're doing your numbers, hey, I'm going to buy a home with 20% down or 5% down or whatever the amount is that you want to do, you don't want to forget the closing costs, because if the home is, $1 million home and we're talking about the closing costs being 4%, that's $40,000. So you do not want to miscalculate. And of course, the loan officer will communicate this to you. But if you're preparing for a home right now, you also want to make sure you keep the closing costs in mind. Like I said, it's 2 to 4% of the purchase price. And those 2 things will make up your cash to close or your total out of pocket when purchasing a home. All right, number 2 mistake most first-time home buyers make is not requesting or asking for multiple quotes. And the reason this is important is because there can be a program that you think is right for you. Maybe you saw it on TikTok, maybe you saw it on Instagram, maybe you saw it on the news. But, after the loan officer reviews your documentation, once they see a clear picture, there may be a different program that best suits you. And the trouble here, and why I'm saying it's best you ask for it, is because some loan officers will just be order takers. You'll tell them, I want an FHA loan or I want a conventional loan, and that's what they'll spit out and give you. When in reality, it could be a different loan, another program that best suits you. So something that I always do for all of my clients, regardless of what loan they're looking for, I'll always provide them with multiple quotes, multiple programs, multiple options. Because like I said, there may be a program that exists that you don't know about. Or you may think that a large payment is what you want to do, when in reality, a smaller down payment is better for you. So it's very important that you ask your loan officer when you're out there getting these quotes is, hey, get me multiple quotes for multiple programs. Give me one at 5% down, 10%, just so you can also have the confidence that you made the right decision in choosing the mortgage that best fits your needs. All right, number 3 mistake that most first-time home buyers make is not understanding or knowing about discount points. Discount points is simply the technical term to buying down the interest rate. In other words, you're going to be paying money, extra money, in exchange for an interest rate below market. So let's say interest rates are at 5% and you're like, hey, I want a lower interest rate, because just because rates are at 5% doesn't mean you need to get a 5%. Just because rates are at 7% doesn't mean you need to get a 7%. You can buy these discount points. And how much these are going to cost you is based on the loan amount. So if you want to buy 1 point, that's going to be 1% of the loan amount. If it's a $100,000 loan amount, it's going to cost you $1,000. If you want to buy half a point, you can also do that. You don't need to buy 1 or 2 points. You can buy a quarter point, half a point, 0.75 points. And that's going to get you a lower interest rate. Of course, the more points you buy, the lower the interest rate. Another detail I want to add here is just because you're buying 1 discount point does not mean the interest rate drops by 1%. It can drop by 1/4%. It can drop by 0.5%. And you can simply ask your loan officer, hey, if I buy 1 point, how much does my interest rate drop by? Now, a very, very important thing here about discount points is that you're paying money in exchange for a lower interest rate, right? And that lower interest rate is going to look pretty. It's going to look nice. Hey, I'm getting a 4% instead of a 5%, or I'm getting a 4.5% instead of a 5%. But what we want to look into here is, hey, how much is it costing you for that lower interest rate, and how much is that lower interest rate saving you? Because let's say you paid $10,000 for that 4.5% interest rate. For example, let's say it's saving you $100 a month. In 1 year, that's going to be $1,200 in savings, but you paid $10,000. So you're going to break even in about 8 or 9 years. So if you're going to sell that home or you're going to refinance in 6 months or in 1 year, it's not a good deal to buy that many discount points or to pay $10,000 for that lower interest rate. So there's another thing you want to go over with your loan officer is, hey, if I do buy these discount points, when's my break even point and how much am I going to be saving a month? Number 4 mistake most first-time home buyers make is having too many debts or co-signing for friends and family. Why is this? Well, the most important part of your mortgage application, like I mentioned earlier, is your income. And if you have too many debts, it doesn't matter how much income you have. All those debts can wipe out your income or slash it in half. I've had clients that make $10,000 a month, $20,000 a month, but they have so many debts and all those debts are eating up their income. So despite making $10,000 a month, their income at the end of the day after those monthly debts is maybe $3,000. So it's very important that you're strategic with your debts, especially like I said, those monthly payments, because the bank's not going to care too much about what your balance is. They're just looking at the monthly payments. Another point here is co-signing, because when you co-sign for someone, that debt, that monthly payment is going to show up on your credit profile. So when the loan officer runs your credit, it's going to show, hey, you co-signed for this car, it's $1,000 payment. Now that's going to be subtracted from your income. And there are ways that we can remove this. For example, if it's a car payment and you're not making the payment, let's say it's a family member or a friend, and we can provide 10 to 12 months of bank statements showing that you don't make the payment, we can go ahead and remove that. But what happens if that person doesn't want to provide those bank statements? That's actually happened to a client of mine where they co-signed for a great friend. They wanted to buy a home. They needed that extra income because he wasn't making that payment, the friend was. And when he asked his friend for those bank statements, he did not want to provide them. So don't put yourself in that position. Make sure you're watching out who you co-sign for. I personally wouldn't co-sign for anyone, but that's the data when it comes to co-signing and how it can affect your mortgage application. All right, and the 5th mistake that most first-time home buyers make is thinking they need 20% down to purchase their first home. Guys, you can buy your first home with as little as 3% down with a conventional loan and 3.5% down with an FHA loan. And there's even down payment assistance programs that we have that offer 0% down to purchase your first home. So do not let the down payment keep you from purchasing your first home. Another thing I want to mention here is that working with a great real estate agent and a great loan officer is also very important when it comes to saving you money. So don't just think, hey, we don't have the 3% or we don't have the 5% or 10% or whatever, because if you have a great team behind you, you can save thousands and thousands of dollars. For instance, we just helped a family purchase their first home. We actually just closed today. They're getting their keys today. And they saved $22,000 on their cash to close. And that's because their real estate agent, which has great experience, is a great agent, he was able to structure the contract, structure the deal in a way where he was able to get the buyers a $16,000 seller credit. A seller credit is basically money that you can use from the seller to pay a portion of your closing costs. And I was also able to help them get a $6,000 lender credit. Their original cash to close was about $56,000. And at the end of the day, with those $22,000 in savings, they only had to come in with $34,000. That's a huge saving, you guys. That's no down payment assistance program. So Also, this is the last point I want to go over here, is that you don't need 20% down, and also you want to make sure you're working with a great real estate agent and a great loan officer. And that's pretty much it for today's video. Thank you guys so much for watching. Any questions, reach out to me. I'm licensed in California. If you guys want me to cover any other things, comment down below any video ideas and I'll work on those videos. And that's pretty much it for today's video. Thanks again so much. Comment down below what you guys thought. Leave a big thumbs up and subscribe for more content just like this. See you in the next one and be great.